So the first area that we are starting is IFRS 15, which is about revenue recognition, or we can say revenue from contract with customers. So when we talk about IFRS 15, IFRS 15 has basically introduced a 5-step model of revenue recognition, where the first step is to identify the contracts. The first step is to identify the contracts. The second step is to identify the performance obligation, which we can also say performance objective. So performance obligation and performance objective is the same. The third step is to identify the contract price, and it will be difficult to cover IS 12 as well in the current session, but I've covered IS 12 in quite detail in the previous webinar, so you can refer to one of the recorded videos of that. Step 4 is to allocate the transaction price. We can even say this to be the transaction price. So allocate the transaction price to the performance obligation. And the last step is to recognize revenue and the performance obligation is met. A performance obligation is satisfied. So these are the 5 steps through which we are going to recognize the revenue. I will share a recorded lecture of that. Now, let's start discussing from the first point that when we say identify the contract, this means that we have to identify how many contracts have we signed with different customers. Now, normally IFRS 15 is applied. IFRS 15 is applied on each contract. Every contract is dealt separately, but IFRS 15 still allows that similar contracts can be aggregated and then accounted for all together. That is allowed as per IFRS 15. Although the core objective of IFRS 15 is to identify each contract separately. So if we have contracts signed with 10 different customers, so we have to identify all the 10 different contracts. Now, when we say identify the contract, there are certain criteria which need to be met for the contract to be a contract. The first is it should be approved by both the parties. It should be approved by both the parties. So if the buyer and the seller have not signed the contract, they have not approved the contract, we are not going to consider that to be the contract, because any contract which is not approved is not a legal binding. So that is why we do not consider that to be a contract. The second criteria is that the rights and responsibilities are clearly defined. Whatever are the rights and the responsibilities, these should be clearly defined, that what is my obligation, what is customer's obligation. So these should be clearly defined. The third thing is that the payment terms should be identified. What amount will be paid? When will the amount be paid? So these payment terms should be identified. What amount will be paid at what time? Yes, Jesse, even if we have agreed verbally, we call that approved, because by law, it can be approved in the written form, in the oral form, or in the implied form. Sometimes the contracts are even approved in an implied manner. Okay, so the contract should be approved by both the parties. Rights and responsibilities should be clearly defined. Payment terms should be identified. The fourth criteria is that the consideration to be received is probable. So it should be probable that we will be receiving the consideration for the work that we are doing. So if the consideration is probable, only then we are going to call it to be a contract. So let's suppose if we are selling the goods to a customer who is already in financial difficulty, this means we cannot recognize revenue in that, because in that case, the inflow is not probable. Yes, Jesse, all the criteria need to be met. Whenever we say criteria, this means all criteria should be met. So the word criteria by default means all of them should be met. So these are the criteria which should be required in an order to consider the contract to be a contract. Now the second step is identify the performance obligation. Now when we identify the performance obligation, what exactly the word performance obligation means? What does the word performance obligation means? Onerous contracts are related to IS 37 actually. So the performance obligation is actually the promise to provide distinct goods or services. The promise to provide distinct goods or services is what is called the performance obligation. Now the word distinct is very important. What does the word distinct actually means? Distinct means products or services which can be sold separately. Which can be sold separately. So now let's suppose that there's a company who um, who usually sells a product, some goods, and additionally, or we can say that we are selling product A and product B. So product A, if the product A can be sold separately, we are going to call it to be a distinct. If the product B can be sold separately, again we are going to call this distinct. Okay, just a minute, there's some internet connectivity issue. Jesse saying, is it necessary to have to remember all the key term names such as performance obligation, distinct? Yes, Jesse, these are very important to be remembered because this is what will allow us to score good marks, because uh, we as per the professionals, we should be knowing these technical terms. Yes, Bibi Fatma, the laptop has disconnected from the internet. So I'm trying to connect it again. Hana, the summarized notes can be checked from the past cards, actually the past notes. They would be quite helpful for the revision. Okay, so the laptop is back. Okay, so let's resume now. We were discussing that let's suppose we are a company who sells product A and B combined. But our competitors, they sell them separately as well. The competitor sells product A separately and product B separately. Now, in that case, for us, are the product A and B distinct or not? For us, are the products A and B distinct or not? Because we don't sell them separately, but the competitors do. So are these distinct or not? Siri is saying no. Hannah is saying yes. So we have a mixed opinion. Well, in this case, we are going to say that the products are not distinct because we don't sell them separately. Again, some issue with the internet of the laptop. Just give me a minute. Okay, so let's resume back. So we were discussing that in such a case, we are not going to consider product A and B as being distinct because we don't sell them separately. So these contracts, this identification is actually company wise at the company's level, that whether the products are distinct or not. So we're going to decide that at the entity level, not at the industry level. Getting this, everyone? So performance obligation are the distinct goods or services. Now one more question, that let's suppose again we have two products, product A and B. A can be sold separately, but B can only be sold with A. This can only be sold with product A. Now in this case, are these distinct or not? Imran is saying no. Are these goods distinct or not? Hannah is saying A is but B is not. Hannah, that's not possible because either both will be distinct or both will not be distinct. Ajmal is saying these are two performance obligation. Bangani is saying not distinct. Chaniya is saying no. Siri is saying no. Mohammed Lamin is saying no. Beverly is saying yes. Basically, the answer is yes, they are distinct. They are distinct. Even if any single product can be sold separately, we're going to say that these are distinct. Like, let me give you an example, a more detailed one. Let's say we are selling goods and we are giving warranty additionally. So now obviously the goods can be bought without warranty, but the warranty cannot be bought without the goods. That's not possible. That I'm not purchasing the goods, but I'm purchasing the warranty only. That's not possible. So even if any single product can be sold separately, that will become a distinct. So if A can be sold separately, that's distinct, irrespective of what is about the B. If the goods can be sold separately, these are distinct, irrespective of what about the other product. Now there's one more thing that we need to understand when we talk about warranty. There are two types of warranty. One is called assurance type warranty. One is called assurance type warranty, and the other is called service type warranty. There are two different types of warranty in case of IFRS 15. Now the assurance type warranty is out of the scope of IFRS 15, and this is accounted for under IAS 37. And how do we identify whether the warranty is assurance type or service type? In case of assurance type warranty, there are no separate charges for this warranty. This means this type of warranty will be provided for free of cost. So any warranty given for free is called the assurance type warranty. And whatever is billed separately or additionally, or we can say which is not free, that is called a service type warranty. So assurance type warranty is accounted for under IAS 37 and a provision is made for that. But the service type warranty for that, we treat it as a separate performance obligation under IFRS 15. So even in case of warranty, we need to determine whether it's a service type or an assurance type, and then we decide whether it's under IFRS 15 or not. Getting this, everyone? Imran is saying, but warranty cannot be sold alone. So how is it a separate performance? It's only be sold within something. Basically, Imran, if I say that there are two products, product A and product B, and product B cannot be sold separately. It can only be sold with A, but A can be sold separately. This means A is separate from B. A is separate from B. So when A is separate from B, this means B is also separate from A. So by default, that becomes a distinct. We are calling A to be a distinct, which means it is a separate obligation. Then automatically B would also become a distinct. Okay, Imran has got it. Thank you. Hannah is also crystal clear now. That's great. So we were discussing about step 2, where we have to identify the performance obligation. And what exactly is a performance obligation? It is a promise to provide distinct goods or services. Distinct means which can be sold separately. Now the third step is to identify the transaction price. This is comparatively a more challenging one. When we say transaction price, what exactly is the transaction price? This means the consideration that the entity expects to receive. Consideration that the entity expects to receive. Transaction price is the consideration that the entity expects to receive. Now let's suppose we say, let's say we talk about the sale or return basis. Let's talk about the sale or return basis. Now, what exactly is a sale or return basis? That usually what happens that the company, yes, Ahmadabi, we can call that sale price as well. That the company sells the goods to the retailers, and the retailers sell the goods to the end consumers. Now, normally what happens that the company provides the goods to the retailer on sale or return basis, which means if the retailer is able to sell it to the customer, the retailer gives us the cash. And otherwise, if the retailer is not able to sell something to the customer, the retailer can simply return that back to us. So either the retailer sell it or the retailer return it back to us. So this is called sale or return basis. Now let's suppose the company sold $100 million goods to the retailers on a sale or return basis. The question is, should we recognize this as a revenue or not? Should we recognize this as a revenue or not? Muhammad Lamin is saying no. Gania is also saying no. Bongani is saying no. Sarah is saying no. Randolph is saying yes, but that is with some conditions. Bongani is saying that the performance obligation is not met. Okay. Basically, the answer is that we should make an estimate. We should make an estimate that as per our expectation, how many goods will be returned and how many cash will we get. So we have to develop an expectation. Like let's say we say that the 40% chances are that entire 100 million cash will be received, and 30% chances are that we will receive 70 million, and 20% chances are that we will receive only $50 million of the cash, and 10% chances are that we are going to receive only $30 million of the cash. So there are different chances based on the past experience. So we should ideally take the expected value of all these and then recognize the revenue. So that's 40, 20, 10, and 3. So in this case, we should be recognizing the revenue at $84 million. So based on the expectation, we should be recognizing the revenue. That is what we have said over here as well. Consideration is the consideration that the entity expects to receive. So we should take our expectation, and when we say expectation, the expectation means either the expected value or the most likely outcome. It can either be the most likely outcome or the expected value. So when we have only two possible situations, then we follow the most likely outcome. When we have only two possibilities or few possibilities, we follow the most likely outcome. And when we have multiple possibilities, we follow the expected value. Like let me give you an example. That let's say we sign a contract with a customer that we are going to deliver some goods to the customer in 2 years' time. We are, let's suppose, developing, constructing a building for the customer in 2 years' time, and for that we are going to charge $100 million. And if the work is delayed, so a penalty will apply of $10,000 on a per day basis. And if the work is done early, a premium will be given of same $10,000 per day. So we have agreed a price of 100 million, but if the work gets delayed, a penalty of 10,000 per day will be charged. And if it's done early, a premium of 10,000 per day will be given. Now exactly how many days are we going to delay, or how many days will we complete the task early? Are there only two possibilities, or are there multiple possibilities? Are there few possibilities or multiple possibilities? Imran is saying two, Hana is saying multiple, Mohammed Lamin is saying two. Actually, there are multiple possibilities. There are not two possibilities, there are multiple. Because maybe we may get a delay of 10 days, or we may get a delay of 12 days, or a 15 days, or 20 days, or 30 days, or 50 days, or 80 days, or 90 days, or 100 days. So there are endless possibilities in this case. There are endless possibilities in this case. So we say that in this type of transaction, we should be recognizing the revenue based on the expected value. But let's say if we change the example a bit, a similar example, that we are constructing a building for 2 years, in 2 years' time, for $100 million. And the question says that if it takes around 2.5 years, then a penalty of $10 million will be charged. And if it's done within 1.5 years, then a premium of $10 million will be given. In this case, we say that there are only few possibilities. In total, there are three possibilities. One, we get 100 million. The other, we get 110 million. The third is we get 90 million. So in this, the possibilities are quite few. So in this case, we can go towards the most likely outcome. So if it's most likely that we will complete the task early, we are going to say that the transaction price is 110, because it's most likely that we will cover that within 1.5 years. And if it's most likely that we will get the project delayed, then we are going to say the transaction price should be 90. And if we do not have any most likely outcome, then we have to move towards the expected value. Getting this, everyone? So first we check that is there any most likely outcome possible or not. If not, go towards the expected value. Okay, that's great. People have understood it. So transaction price is the consideration that the entity expects to receive. Now that actually had multiple further discussions for the understanding. Okay, so let me make some space over here. Or let's ignore it. It's quite difficult for me to make the space. So we have discussed the first point, that the consideration is what the entity expects to receive. Yes, Hannah, thank you, but let's ignore that for the time being. Now the second point is that variable consideration we are discussing step 3 over here. The variable consideration should be included if that's highly probable. So in case of variable consideration, we should only be including if that is highly probable. Plus, we say that the consideration or the transaction price should be based on time value of money. And when we say time value of money, it includes both the discounting and the compounding. It includes both the discounting and compounding. Now, what do we mean by that? If we talk about this, let's have two different examples. Example 1, that let's suppose we sold the goods in year 0, and after 1 year we are going to receive the cash of $110 million. Let's assume a discount factor of 10%. This means in year 0, when we have sold the goods, we should be recording an entry as the receivables debit and the sales credit. But because we are receiving the cash after 1 year, we should be recognizing it at the present value. So the present value would be $110 million divided by 1 plus I to the power n, where I is 10%, n is 1. So we should be recording the sale at only $100 million, because that is the present value of the cash that we will be receiving. Now, after 1 year, we are going to make another entry as the receivables debit and the interest income credit. So we assume that we are earning 10% interest on this. We assume that we are earning 10% interest on this. So 10% of $100 million will give us a value of 10 million. And now when we receive the amount of 110 million, we are going to debit the bank and we are going to credit the receivables by 110 million. So this is how we are going to record the transaction in case where we are receiving the amount in the later years. We are selling the goods today, but we are receiving the cash in the later years. Similarly, let's take an opposite case, a vice versa case, that we receive the cash of $100 million today, and after 1 year, we are going to sell the goods. So in this case, because we have received the amount, we are going to make an entry as the bank debit by 100 million. And this amount is an unearned income for us. So we are going to record the unearned income at $100 million. We are assuming that the same discount factor to be the 10%. So now at the year end, first we are going to record the finance cost debit and the unearned income credit by 10%. Because if we are receiving the cash early, why would a customer pay us an early cash? Obviously, in return, we will be selling some additional goods to the customer. So that additional goods which we will be delivering is what is the interest expense. So first we are going to record the finance cost, and then we are going to say that the unearned income should be debited by 10 million and the revenue should be credited by 10 million. Getting this, everyone? So one more example was relating to the discounting, the first one. The next was relating to the compounding. Cindy is not clear on the unearned income. Cindy, we received the cash of 100 million in year 0, so we debited the bank. But because we haven't sold the goods yet, that is why we recorded it as an unearned income of same $100 million. Now, because we are selling the goods 1 year afterwards, we should be compounding this unearned income by 10%. Irrespective of whether we will be selling additional goods or not, the standard assumes that we should ideally compound the unearned income by increasing it by 10%. So we credited the unearned income by 10% and we debited the finance cost by 10 million. Now when we sell the goods, the unearned income was actually at 110. Sorry, this is 110. So 100 was the unearned income and 10 is the what the interest was. So this 110 million should then be recorded in the revenue. So this is based on an assumption that it should be increased. Getting this, Cindy? Yes, Samsung Galaxy S9, this is revenue recognition. Randolph is saying, sir, so on the first example, what amount should be stated on the customer's invoice if customer will pay in the future? Randolph, whatever we are showing on the invoice is something else. What accounting we need to do is what we have discussed, because we usually need to manage the customers differently. If we show the same amount on their invoice, that would create a problem for us. Yes, Jesse, unearned income is the deferred income actually. Yes, Ahmed Nabi, it's more like unwinding actually. Cindy is clear. Josie is saying deferred income and advance. What is the difference? It is the same, Josie, but the advance, the word advance can be used both for the asset and the liability. Advance income is a liability, advance expense is an asset. So that's why it's better not to use the word advance, because that is not exactly making it clear what's in the advance. But the deferred income makes it quite clear that we have received the cash, but we haven't recorded the income yet. So the word deferred income is comparatively better for the liabilities. Okay. So now when we talk about IFRS 15, we just discussed that how do we incorporate the time value of money into the revenue recognition. Okay, Galaxy A70 is saying, please repeat on the unearned income debit revenue credit. Basically, when we have sold the goods after the first year, this means that now we have earned the income. So there's no need of the unearned income. So we simply debit that, eliminate that, and we recognize the same amount as a revenue. Ganya is saying revenue is recognized when control is transferred. In your example, control is transferred when cash is received in advance. No, Ganya. In our example, the control is transferred at the time of sale. That's why we are recording the revenue at the time of sale. Okay, Ganya is also clear on this. So now let's get back to the transaction price. So we have discussed 3 points. The fourth point is, if any amount is paid to the customer due to any reason, any amount paid to the customer is treated as a reduction in the transaction price. Now, sometime what happens, yes, exactly, Cindy is clear now. So now let's have an example that usually what happens, that why should I be paying the amount to the customer? The customer should pay the amount to us. Why would we pay to the customer? The reason behind can be, let's say, if the company is making a contract with the customer who is a retailer. Let's suppose I'm a company and I go to the retailer and say that let's make a contract that you will purchase goods of around $70 million in the current year. And in return, I'm going to revamp your shop. You make a contract with me that you will be selling goods of $70 million, and in return, I will revamp your shop. So I will pay you, let's say $10 million to revamp your shop, and then you have to buy $70 million of the goods from me throughout the year. So 10 million is what we have paid. We pay to the customer. Why? To revamp the shop. So this is an amount that we are paying to the customer. So we paid 10 million, and in the later year we received 70 million of the sales. So ideally we are going to say that the transaction price is not 70 million, rather the transaction price is only 60 million. 70 million minus the amount paid to the customer. So if any amount is paid to the customer, that will be deducted from the transaction price. No, Harun, the tendering is something different, and this is something different. Tendering is a separate type of a cost. Yes, Asif, the net sales would be 60 million only. Okay, so now let's continue. So we have discussed multiple points in the transaction price. Now there's one more point, that in case of non-cash consideration, if we are receiving non-cash consideration, transaction price is the fair value of the consideration received. So if we are receiving a non-cash consideration, okay, just give me a minute, some internet connectivity issues today. So in case of non-cash consideration, yes, it's back. So in case of non-cash consideration, transaction price is the fair value of the consideration that we have received. So let's suppose that we are selling product A to someone, and in return the customer is going to give us product B. So this means the fair value of the product B is the selling price for product A. So whatever is the fair value that we are receiving is the consideration that we are getting. So this is how we actually calculate the step 3 to identify the transaction price. Now the next step is the step 4. And in step 4, we are going to allocate the transaction price to the performance obligation. Now we say that the allocation should be based on the relative standalone price. Standalone price, the price applicable if the product was sold alone. Price if the product was sold alone, separately, we can also say. And the second point is that in case of variable consideration, or discount, it can be allocated to one or more performance obligation. It can be allocated to one or more performance obligation. Now let's have an example to understand this. Let's suppose that we had product A and product B. The price of product A is 6,000 standalone. The price of product B is 4,000 standalone, which makes it a total of 10,000. But we have agreed with the customer to give them these products for only 6,000, or let's say only 8,000. This means that we are giving a discount of 2000. Now, how should we allocate the discount? So the standards say that we can allocate it to one or more performance obligation, which means that maybe we would have given the discount because of product A only. Usually, when does a company give the discount? Usually, when does a company give the discount? The company gives the discount when one product is a running product and the other is not. When one is a running product and the other is not, then the company gives the discount. So maybe we have given the discount to run product A. So this means the breakup of 8,000 is going to be 4,000 and 4,000. But maybe product A is a running product and product B is the one which needs support. So that means it will be 6,000 and 2,000. Now the 2,000 discount is allocated to product B only. So now the discount is allocated to product B only. And the third possibility is that both the products are running, but as a marketing strategy, we are providing both of them together. In that case, we will allocate the discount to both of them. And the allocation should be based on the standalone price. This means that the standalone price in total was 10,000. The breakup was 6 and 4. So we can say product A is 60% of the total and product B is 40% of the total. Product A is 60% of the total and product B is 40% of the total. So this means 60% of 8,000, which is 4,800, will be product A and 40% of 8,000 will be product B. So in the first two cases, we allocated to only one. And in this case, we allocated to more than one. So the discount can be allocated to one or more performance obligation. Is it clear to all of you? Yes, exactly, Mohammed Lamin. You have got it right. Cindy saying, will the question tell us the basis? Cindy, if the question does not tell us the basis, we will write all possibilities. Okay, Sarah wants me to repeat 4,800. Sarah, we actually got 60%. So 60% of 8,000 is 4,800 and 40% of 8,000 is 3,200. This is how we made the breakup of 8,000. Getting it, Sarah? Okay, great. So now the last step, step 5, is to recognize revenue when the performance obligation is met. So recognize revenue means when obligation is met, when obligation is satisfied. Now, when is the obligation satisfied? So we say obligation is satisfied when the control is transferred. So when the control is transferred, we say that the obligation has been satisfied. Now you can recognize the revenue. And how do we know that the control has been transferred? So we say there are certain indications which will tell us whether the control has been transferred or not. These are not the criteria, these are the indications. The first is that the legal title has been transferred. So if we have transferred the legal title, this means might be the control has been transferred. Or the physical possession has been given. So even if the physical possession has been given to the customer, again, this is an indication that the control might have been transferred. And the third is that our right to payment has been developed. So if our right to payment has been developed, this again means that the control has been transferred. That is why our right to the payment has been developed. But do remember, these are not the criteria, these are the indications. Looking at these factors, we need to decide whether the control has been transferred or not. Now, when we say control has been transferred, so again, the control can be transferred in two ways. Either it will be transferred at a point in time or over a period of time. So there are two ways to transfer the control. Either it is going to be transferred immediately or it is going to be transferred over a period of time. If it's transferred at a point in time, then the revenue is recognized immediately. As we transfer the control, we recognize the revenue immediately. And if it's transferred over a period of time, in that case, we recognize revenue. Revenue is recognized based on the percentage of completion. So whatever percentage of the work has been done, that is the amount by which we should be recognizing the revenue. And how do we know that whether the control is transferred over a period or not? It's transferred over a period when the customer obtains benefit as the company performs its obligation. So if as we are performing or completing our obligation, the customer is getting the benefit meanwhile, this means that the control is being transferred over a period of time. And when do we know that it's transferred at a point in time? So the answer is simple. If the control is not transferred over a period of time, then we say it's transferred at a point in time. There's no specific definition of control being transferred at a point in time. If it's not over time, then it's a point in time. So if the control is not transferred over a period of time, then it's transferred at a point in time. So we can say that at a point in time is sort of having no definition specific. This is given example if a company is transferred over the time while study material is at a point in time. Tuition is transferred over the time while study material is at a point. Yes, exactly, Jesse, you're right. Josie is saying, what if the supplier obtains benefit if they complete early? Josie, if they are getting the benefit after completion, whether it's early or on time or delayed, if they are getting the benefit after the completion, that means it's at a point in time. So we can say that if you're talking about the benefit, the benefit will either get after completion or during completion. So if the benefit is after completion, then it's at a point in time. And if it's during completion, we call this over a period of time. Getting this, everyone? Okay, the sound was having some problems, but I hope that's resolved now. Okay, so I hope the point is clear. That's great. So that was all about IFRS 15, where we discussed 5 different steps of the revenue recognition. Okay, so he wants a snapshot. Here you go, you can take the snapshot now. Okay, so that's great. Now let's solve some of the past papers to apply these rules on the real exam questions. Kashifa, IFRS 2 was examined during the last attempt, so that is why it's comparatively less important. But the IAS 12 is still important. Hannah saying, please no break today. And that would be difficult because studying 3 hours continuously will be difficult for you people. Plus, teaching 3 hours continuously will be difficult for me too. So, we can find any alternate route for that. Jesse, there's no current issue on IFRS 15. Imran, IFRS 9 will be covered after this standard. Okay, so we have a question by the name of Skizzer. This is one of the past papers question, and there's a part that relates to IFRS 15 in this. Okay, Judy, we will try, cannot guarantee that. Cindy, I will let you know in a while. So we were discussing about IFRS 15 and we have a case of sale of development project. The question says that on 1st September 20x6, Skizzer acquired a development project as part of a business combination. So we actually acquired a subsidiary along which we got a development project. Development project means IAS 38, intangible asset. And correctly recognize the project as an intangible asset. So that's right. However, in the financial statements to 31st August 20x7, which was by the year end, Skizzer recognized an impairment loss for the full amount of the intangible asset. So completely written off was the intangible asset, because of uncertainties surrounding the completion of the project. So we were not sure whether the project would be completed or not. So we simply wrote it off. During the year ended 31st August 20x8, which is 1 year later than that, the directors of Skizzer judged that it could not complete the project on its own and could not find a suitable entity to jointly develop it. Thus, Skizzer decided to sell the project. So they've decided to sell the project, including all rights to future development. Skizzer succeeded in selling the project, and as the project had a nil carrying value, it treated the sale proceeds as revenue. So if they have treated the sale proceeds as the revenue, the directors of Skizzer argued that IFRS 15 states that revenue should be recognized when the control is transferred at a point in time. So yes, the control is transferred at a point in time in this case, but is selling the intangible asset a normal course of business for us or not? That's the question. The directors of Skizzer argued that the sale of the right was part of their business model and that the control of the project has passed to the purchaser. Now, what's the requirement of the question? It's a small 4 marks requirement which says discuss whether the proceeds of the sale of development project above should be treated as revenue in the financial statements. So what's your call? Is it a revenue or not? And I saying no. And what's the reason if you are saying no? Why no? I don't say because it's an intangible asset. So yes, a lot of people are giving the right answer. So let's write it quickly. We are going to say that we're writing the answer of the Skizzer. And let me read one more thing from the question that will make it more easier for us to answer. There are 2 lines above as well. It says that Skizzer is a pharmaceutical company which develops new products with other pharmaceutical companies that have appropriate production facilities. So being a pharmaceutical company, we develop the new products to use those rather than to sell those. So we are going to say that IFRS 15 revenue from contract with customers deals with the rules of revenue recognition, or we can say these with the principles of revenue recognition. As per IFRS 15, revenue can only be recognized. Okay. Sorry for that. Exactly, Harun, but the question is talking about IFRS 15. That's why we have to answer it as per IFRS 15. So we are going to say that as per IFRS 15, revenue can only be recognized for the contract with the customers. In case of Skizzer, it is a pharmaceutical company and usually uses the intangible assets. to develop medicines and sell those in the market to generate revenue. And would be using, because we are not sure whether this is the case or not. So because we are assuming, that is why we are saying would be using. The intangible asset sold during the current year is not being sold to the customer, as it is not a normal course of the business, therefore shall not be recognized as a part of revenue. So that's the simple answer. And I think most of the people are clear on this. So there is no need to take it into too much of the details. Now, if we go back to the question again and solve one more new question, this should be treated as a simple disposal proceed. So it should be treated as a gain or loss on disposal. It should be treated as a gain or loss on disposal. Now we have a question of Kiki, and this is a detailed one. So let's solve one part before the break and the other after the break. It says Kiki is a public limited entity. It designs and manufactures children's toys. It has a reporting date of 31st December 2007 and prepares its financial statements in accordance with the IFRS. The directors require advice about the following situation. Okay, a lot of people want the snapshot of the answer and the question. So here's the answer. You can take the snapshot quickly. And here's the question. You can take the snapshot of the question as well. I'm zooming out to include the requirement as well. So we have discussed this requirement, part 3. And you can take the snapshot. Take it, everyone. So let's get back to the Kiki question. T is saying, should we not tell the revenue recognition criteria, because we are not taking the case to IFRS 15. That is why there's no need of writing the criteria of IFRS 15. Now the question says that Kiki sells $50 gift cards. These can be used when purchasing any of Kiki's products through its website. So we have sold a $50 gift card, and this can be used from purchasing the products on the website. The gift card expires after 12 months. Based on significant past experience, Kiki estimates that its customers would redeem 70% of the value of the gift card and 30% of the value would expire unused. So based on the past experience, we know that they will use only 70% and 30% will not be used. So Kiki has no requirement to remit any unused funds to the customers when the gift card expires unused. So this means that the amount is non-refundable in act. So how should we recognize the revenue? How should we recognize the revenue? Actually, in this case, we will recognize 70% as revenue when consumed. 70% will be recorded as revenue when they are consumed. And what about remaining 30%? That 30% should be recorded as revenue with this 70%. 30% should be recorded as revenue with the 70%, which means that out of $50, we are expecting the customer to use 70%, which is 35, and not use 30%, which is 15. So we have to recognize the revenue of $50 on the consumption of $35. We have to record the revenue of $50 on the consumption of 35, so that this 15 can also be recorded along with the 35. So if I divide 50 by 35 using a calculator, that will be 50 divided by 35 as 1.43. So we can say that ideally we should be recognizing $1.43 of revenue on the consumption of every $1. So on the consumption of every $1, we simply record the revenue as 1.43. That will make the revenue of $50 on the consumption of 35. Getting this, everyone? So if we write it on the answer sheet, we can say we are solving the question of Kiki. And we are going to say that as per IFRS 15, or we can say IFRS 15 has a 5-step model of revenue recognition, where step 5 is to recognize revenue when the control has been transferred, which is transferred when the performance obligation is met. However, if it is reasonably certain that a non-refundable amount will not be used by the customer, that amount shall be recognized as revenue along with the consumed amount. In case of Kiki, it has a reasonable past experience that 30% of the gift card will not be consumed. Therefore, this 30% should be recorded or recognized as revenue along with the expected consumption of 70%. To incorporate this, Kiki should recognize revenue of $1.43, which is $50 divided by $35 on the consumption of every $1 by the customer. So that is what was supposed to be the answer in this question. Harun is saying by consume, does it mean when the gift card is sold to the customer or when it is redeemed by the customer? Harun, consume means redeem, because on redemption, the customer is using or consuming the card. This is saying if the question never mentioned 30% is non-refundable amount, do we recognize 30% as revenue? Jesse, if 30% would have been refundable, then we should be recognizing it as a liability. Then the treatment would have been recognizing 70% on consumption and recording the unconsumed amount as a liability, because the customer will take back the cash for that amount. Similarly, we can also say, just for your understanding, that if Kiki did not had a reasonable past experience, the revenue of 30% would have been recognized on expiry of the contract. So because we had a reasonable past experience, that is why we mentioned that, recognize that along with 70%. Cindy saying, can you suggest some other questions as well? Yes, Cindy, I will suggest the questions after the break. Once we are done with the Kiki, then we will be discussing the area of IFRS 9. Ahmed Nabi wants to read the question. Here you go, Ahmed Nabi. So let's take a break now. And after the break of 10 to 15 minutes, we're going to continue back. Jesse, we have applied step 5 in the Kiki, that we are recognizing the revenue when the control has been transferred. So we are taking a break of 15 minutes. And then we are going to come back and continue with this. Okay, everyone, welcome back from the break. And there are some questions. Mohammed Lami is saying, would you help us with all the revision notes before the end? Okay, Mohammed Lami, I will share a compiled document which will include all of the summaries of the standards. So you can benefit from that. Fasiya saying, I didn't receive the lecture link for recorded lectures for day 2 and 3. Fasiya, I've shared that on the WhatsApp group. If you're there, you can get it from over there. Cindy saying, sir, can you also ensure that OneNote and the answers? Yes, Cindy. I have a new link for the OneDrive actually. I will share the link on the group. And I will share on the WhatsApp group. Harun saying, can you please let us know where you will upload the video for ethics and current issues? A link through email, Vimeo, or YouTube. Harun, it will be a link through email actually. It will be a link through email. Fasiya is saying, I'm not a part of the WhatsApp group. Okay, Fasiya, I will also be sending the email, the WhatsApp group link and all of the video links so you can be a part of the group as well as you can be the lectures. Okay, that's great. So let's start the question. We were discussing the Kiki's question and we're solving the next part, then moving on towards the Ifrs 9 because we have a quite less time left. Harun, don't worry. I will send an email with the group link to all of the registered users. Okay, now the question says Kiki's best-selling range of toys is called Scarymon. In 20x6 color, another listed company entered into a contract with Kiki for the rights to use Scarymon character and imagery in a monthly comic book. So in 20x6 color, another listed company entered into the contract with Kiki. So we have a contract with the company Color where we are giving the rights to use the Scarymon characters and imagery in a monthly comic book. The contract terms state that Color must pay Kiki a royalty fee. So royalty fee is the revenue that we will be earning for every issue of the comic book which is sold. Before signing the contract, Kiki determined that Color had a strong credit rating. So before signing the contract, the Color has a strong credit rating. Throughout 20x6, Color provided Kiki with the monthly sales figure and paid all amounts due in agreed upon the period. So everything is going good. At the beginning of 20x7, Color experienced cash flow problems. So Color is now experiencing cash flow problems. These were expected to be short term, which means that these will be resolved in few months. Color made nominal payments to Kiki in relation to the comic sales for the first half of the year. At the beginning of July 20x7, which means in the middle of 20x7, Color lost access to credit facilities and several major customers. Color continued to sell Scarymon comics online and through specialist retailers, but made no further payment to Kiki. The directors are unsure as to how to deal with the above issues in the financial statements for the year ended 31st December 20x7. So now apparently the case belongs to which step of IFRS 15? Which step is the question talking about? Imran is saying step 1. Harun is saying expected consideration. Okay, Harun. Bangani is saying last step of recognition. Basically, this is more of step 1 in actual. This is more of step 1 in actual. Because if you remember, we discussed that the revenue is recognized when the consideration is probable. This is the point which the question is talking about. So apparently at the time of contract, it was probable that we will be receiving the consideration, but later on, the situation actually changed. So we are going to write This was Kiki part A. Now we are writing Kiki part B. So we are going to say that as per IFRS 15, step 1 is to identify the contract where the consideration received should be probable. This means that, or we can say, as per IFRS 15, step 1 is to identify the contract where the consideration received should be probable. So we can say in case, or this means that if the consideration was probable but not received later, revenue shall be recognized with an impairment loss later. And if the consideration was not probable at the time of sale, the revenue should not be recognized. Now, in case of Kiki, Color had a strong credit rating at the time of contract and made all payments on time in 20x6. Therefore, Kiki should recognize revenue for all of the sales in 20x6. In 20x7, Color was experiencing difficulties, but as these were short term, it was still probable that Kiki will receive the payments. Therefore, Kiki should recognize revenue for the first half of 20x7 and the amounts not received as a bad debt expense. However, in the later 20x7, in the later 20x7 or in the second half of 20x7, Color lost access to major customers and credit facilities. Therefore, it is no longer probable that Kiki will receive the consideration. Therefore, no revenue should be recorded for the second half of 20x7. So that is what was the answer of Kiki part B. So if we see, we had three different cases in this. During 20x6, we have recorded revenue. In the first half, we recorded revenue plus we recorded the bad debt. And in the last half, we didn't record the revenue. So the question has actually asked all types of issues in a single question. When to recognize revenue, when to recognize revenue plus bad debt, and when not to recognize the revenue. Getting this, everyone? So you can take the snapshot of this. Harun is saying the second half is considered credit risk level 3. Actually, Harun, because in the second half we are not recognizing revenue, so there will be no receivable, so there will be no credit risk level 3. For the sales made in the first half, this one, this period, this is what we can call stage 3. It was initially stage 2, but during the mid of the year, it went to stage 3. Okay, now what additional questions can be done is one of the questions is by the name of calendar. This part you can take the snapshot of this quickly. You can try this at your home. Calendar, this is something similar to the question we did by the name of skizzer. This is something similar to that. Jesse is saying so difficult to do. Jesse, what is the difficult to do? IFRS 15 is difficult. Jesse is saying all past paper questions. Let me confirm the attempt, Cindy and Hannah. So if I go upwards again, there's one more question that you people can try, which is Darlet. This is also one of the questions of IFRS 15. You can try this as well at home. And you can even take the snapshot of this. And if you want one more question, then format is a good question as well. Maha, I will let you people know the years of these areas. And if you want one more question for this, you can even solve this question of Carsoon. This is also one of the IFRS 15 questions. Yes, Jesse, it is difficult to handle the questions without the guidance, obviously. That is why the SBR paper is quite difficult, because this is not about the rules only, plus how to answer those in a new scenario, which is something very important. Okay, Muhammad Ali, I will try that. Jesse saying Carsoon question is too long, reading time is already enough, exceed time to answer the question. Yes, Jesse, these are challenges in the SBR, that the paper is going to be lengthy and you might feel that we don't have sufficient time to complete it on. These are all of the challenges which is quite usual for the SBR exam. So we have to manage time, we have to read it quickly, we have to write the answers quickly so that we can try to complete the questions. Imran, I would suggest to solve maximum questions of IFRS 15, because that is an important area and a difficult one too. For the remaining, we can target some specific. Okay, so now let's talk about IFRS 9. When we talk about IFRS 9, this mainly has three areas: the area of financial accounting, financial assets, financial liabilities, and the third area is the hedging. Now, hedging is the area which comparatively more people find to be difficult. So we will be having the remaining session on the area of hedging, because that is the difficult one. Okay, Madhavi, I will share on the group. Now, when we talk about hedging, hedging actually starts from the topic of derivative. That what exactly is a derivative? We say derivative is an instrument. Derivative is a financial instrument with the following characteristics. Yes, a lot of people struggle in this topic. So the first point is that derivative is a financial instrument. Now, what exactly is a financial instrument? Financial instrument is basically a financial asset of one entity and a financial liability or equity for the other entity. So any instrument which is a financial asset of one entity or a financial liability and equity of another is what is called a financial instrument. Now the characteristics of derivative are not that important, but I'm still writing that down, although we will not be going into too much detail of it, is that it does not have its own price. It does not have its own price. Rather, its price is derived from some other underlying instrument. We will spend less time on studying the hedging and more time on the past papers because that will enhance the understanding of this topic. The second thing is that initial investment is very low or zero. Initial investment is very low or zero. And the third is that it is going to be settled at a later date. So these are three characteristics of a derivative. Now, normally, the forward rate agreements, the futures, the options, and the swaps are what are called the derivatives. These are four types of the normal derivatives. But let's suppose if in the question it gives us any future contract, any forward contract, any option or any swap, we need to check whether this contract relates to a financial instrument or it relates to a non-financial instrument. Like let's suppose we have signed a contract to buy, shares. So because shares is a financial instrument, we are going to classify in this case. But if we are planning to buy inventory in the future, we are planning to buy any property, plant equipment, any intangible asset, all these are non-financial instruments. So if we are making a contract to buy shares, we are making a contract to buy currency, we are making a contract to buy loan notes, all these are financial instruments. So first we need to check whether the contract relates to a financial instrument or a non-financial instrument. If it relates to a financial instrument, we are directly going to call it to be a derivative, because derivative is a financial instrument. So if it's a financial instrument, that's a derivative. But if the contract relates to inventory or the property, plant equipment or intangible asset or any other asset, which is a non-financial instrument, then we have to check whether the contract is going to be settled in cash or the contract is going to be settled in goods. If the contract is going to be settled in cash, it is again a derivative, because cash is also a financial instrument. But if the contract is going to be settled in goods, then we are going to call this instrument to be a non-derivative. Although it's a forward contract, it's a future contract, it is an option, it is a swap, but because it relates to a non-financial instrument and will be settled in a non-financial instrument, that is why we are not going to call it a derivative. Now, if it's a derivative, then its accounting will be as per IFRS 9. And if it's a non-derivative, it is going to be accounted for under IAS 37. If it's under IAS 37, then we need to check if the contract is onerous. Check if the contract is onerous. This means either we are going to have a gain on this contract or a loss. If there's a gain on the contract, we simply ignore that, do nothing. But if there's a loss on this contract, we need to check whether it is expected to be reversed or whether it's expected not to be reversed. So if it's expected not to be reversed, then we are going to call this an onerous contract. And if we are expecting it to be reversed, then we should again ignore that. And if it's an onerous contract, we should be recognizing a provision for the loss. Harun is saying, how can there be gain on the onerous contract? Harun, there cannot be a gain on the onerous contract. That's why I have made this breakup of the contract. We have to check the contract is in loss or is in gain. So we need to check the contract, whether there's a gain on the contract or loss on the contract. So if it's a loss, then check whether it's expected to be reversed or not. Then we decide whether it's honest or not. And if it is if it is a derivative under IFRS 9, then again there are two possibilities, that either this is a case of hedging or other than hedging, because the derivative can be used either for hedging or other than hedging. And if it is a case of other than hedging, then it should be classified in the fair value through P&L category. And if it is a case of hedging, then there are two types of hedge. Either it will be a fair value hedge or a cash flow hedge. So if we have a risk of loss in P&L, we call it a fair value hedge. And if we have a risk of an increase in the cash outflow or a decrease in the cash inflow, then we call it to be a cash flow hedge. In fair value hedge, gains and losses are recorded in the P&L. But in case of cash flow hedge, we recognize the gain or loss in two parts. The effective part goes to OCI and the ineffective part goes to P&L. So this is the overall summary, which is important when we talk about the hedging. So you can take a snapshot of this area because this is the most important one. From here till over here. That first we need to check whether it's a financial instrument or a non-financial. If it's financial, we take this part of the answer. If it's non-financial, we check whether it's cash or goods. If it's cash, back to that part. If it's goods, then this part will be the answer. Why we are going to solve the past paper? Now why? Hannah wants to zoom in towards the cash flow hedge. Hannah, this is ineffective. Maybe that's what you are finding difficult to understand. Ineffective part goes to P&L, effective goes to OCI. Basically, I would suggest do not go into detail of the effective or the ineffective because that is very specific case. Normally, the question takes a bird's eye view on the derivatives rather than a worm's eye view. Huawei is saying, what question can we expect this time from IFRS 9? Basically, the IFRS 9 is a huge standard. You can expect any part of the standard, but the most difficult part is normally the hedging, which we have taken for the discussion purposes. Ganya financial instruments are normally monetary, but that's not necessary. They are normally monetary, but that's not necessary. Okay, now let's go towards the past paper questions of IFRS 9. And IFRS 9 has been quite time since it was examined. So that's an important part. This is the first question that we are going to solve by the name of Darlet. This is an interesting one and a difficult one as well. It says that on 1st September 2016, Darlet entered into a fixed price forward contract to purchase 2,000 tons of steel. Now, steel is a non-financial instrument for which we are making a forward contract. So we need to check whether it will be settled in cash or in goods at 400 euros per ton. So this is the price that we have agreed. The local currency is the dollars. The purchase is in accordance with its normal usage requirement. So this is in accordance with the normal usage requirement, means that this is the 2,000 tons is what is a normal requirement to us. So apparently this statement is diverting our mind that this is going to be settled in steel, not in cash, because it's a normal usage requirement. We need steel. That's why we have made the contract. So apparently this point is taking us towards the expectation that the contract will be settled in goods. The contract allows Dalit to take delivery of the steel on 31st August 2008 or to pay or receive net settlement in cash. So we have an option to either take delivery or settle in cash. So we need to check what is our intention to do. Based upon the changes in the value of steel, but not the change in the value of foreign exchange rate. So that's how the value of the net settlement is going to be decided, but that's not important to us. So whenever the question tells us how it is going to be settled, that's not relevant to us. Darlit has not settled similar contracts in the past before the delivery of steel. So our past practice also shows that we will be settling this in the goods. Darlit does not have a foreign currency contract to hedge against any risk caused by any movement in the dollar-euro exchange rate, and has paid a non-refundable deposit of 100,000 at 1st September 2016. Non-refundable deposit means that again we would be expecting the goods, because otherwise why would we pay a non-refundable deposit when we don't want to purchase the asset? So that makes no sense of giving deposit despite that we don't want to purchase. So this means we are giving a non-refundable deposit, which means we are inclined towards purchasing the steel. So in this case, we are going to say this contract to be a non-derivative contract based on 3 points. It's normal usage. We haven't settled any such contract in the past in cash, and we have given a non-refundable deposit. These 3 points are making it to be a non-derivative contract. So now we need to check whether there's a loss or a gain, and if it is a loss, whether it is expected to be reversed or not. The following exchange rates are relevant, where the rate on 1st September was 2:1 and on 31st August it was 1.75:1. So the rate has actually decreased. And the question further says that there had been no change in the contract price of steel at 31st August 2017. And it is felt that the decline in euro-dollar exchange rate is unlikely to be reversed. So this decrease will not be reversed in actual. The directors of Allocate would like to know how to account for the above contract at 31st August 2017, which means the year end, and whether it's within the scope of IFRS 9. So, and will break the question. So the first requirement is how to account for the above contract and whether it is within the scope of IFRS 9 or not, together with any implication of the change in the dollar-euro exchange rate. So if I go back to the OneNote, we had made a contract to purchase 2,000 tons of wheat. At what price? 400 euros. So if I multiply, this means 800,000 euros is the price that we need to pay. And the rate was initially 2 euro per dollar. It's steel, sorry. The exchange rate was 2 euro per dollar. And later on, it was changed to 1.75 euros per dollar. Now, the first thing is, should we divide the rate or should we multiply the rate? What do you think? Should we divide the rate or should we multiply the rate? Yes, exactly. Everyone is saying divide. Dilpreet is also saying divide. Huawei is saying multiply. So basically, we will be dividing it because the euro is in the numerator. So if it's a numerator, we are going to divide that. But before that, we have even paid 100,000 euros as a non-refundable deposit. So this means that remaining 700,000 euros is what is the payable to us. Although we are not recording it to be a payable, that's a sort of a commitment. So now we are going to divide it by 2. So this means the value was $350,000 initially at the time of the contract. But later on, it changed to 1.75. So if I use a calculator, 700,000 divided by 1.75 is 400,000. Thank you, Imran. So this means that my commitment to pay has increased. So that's a loss. Loss of how much? Loss of $50,000, which was expected not to be received. So this means this is a case of on-risk contract. Yes, exactly, Huawei. Sam is saying, why do you say not to be received? Sorry, Sam. Sorry, not to be reversed. That's not to be reversed. Expected not to be reversed. Okay. So now if we go back to the Word file, So now we are writing the answer for the question Darlet. And this is Darlet part B, which we are answering. So we are going to say that in case of forward contract, if it relates to a financial instrument, or is expected to be settled in cash, it is treated as a derivative under IFRS 9. Otherwise, it shall be treated under IAS 37, where any loss which is not expected to be reversed is recognized as a provision. In case of Darlet, the contract is a normal usage requirement of Darlet. And Darlet has never settled such contract in cash in the past, and has also paid a non-refundable deposit of 100,000 euros, which indicates that the intention of Darlet is to take the delivery of steel. Therefore, shall not be treated as a derivative, and instead IAS 37 shall apply. So now we have answered the one part of the question, which was whether it is within the scope of IFRS 9. So we have mentioned that this is not IFRS 9. Now we are mentioning how to account for the above contract. So we are going to say that as the exchange rate has fallen, it has resulted in a loss of $50,000 to Darlet. And it also mentioned that it is felt that the decline is unlikely to be reversed. So we're going to say that, and as it is unlikely to be reversed, a provision for $50,000 should be recognized in the financial statements. You can say an expense and a provision. So that was the answer to the question of Darlet. Any confusion in this? My saying why expense also, Ma? Because the provision is recognized as an expense. The treatment of provision is to expense actually. Now let's solve one more question. Angela is saying so recorded twice. No, Angela, the entry is expense debit and the provision credit. The entry will be expense debit and the provision credit. So it's recorded once only, not twice, Angela. Zaira is saying it will be a gain when we write off the provision later. Yes, Zaira, if the provision gets reversed, then it's a gain. Yes, Mohammed Lamin, both the things are important. We should have a strong grip on the standards. Plus, we should be able to know what to write when we read the question. So if we are reading a question, we should know exactly what is to be written in this answer. So the knowledge of the standard plus the application, both are very much important. You people can take the snapshot of the answer quickly. Yes, Abdullah, in that case, we are going to record at the present value. If it is going to be settled in multiple years. So now we are solving June 2019 exam question, which was actually of the March, not exactly the June, but it was a hybrid paper. That's why it's March, June 19 and actually. So we have a question of 5 marks in this as well. It says on 1st April 20x7, crypto, which has a functional currency of the dollars, which means a local currency of dollars, entered into a contract to purchase a fixed quantity of electricity. So again, it's a contract to purchase electricity, and electricity is a non-financial instrument. At 31st December 20x8, so approximately 1 year, 9 months later from the date of the contract, for 20 million euros. At that date, the spot rate was $1.5 to the euro. The electricity will be used in crypto's production process. So apparently, we are expecting it to be settled in the electricity, not in the cash. Crypto has separated out a foreign currency embedded derivative for the electricity contract and measured it at the fair value through OCI. Now, this is the area which need to be understood. If I go to the OneNote, we have signed a contract to purchase electricity. So this means, is this a derivative or not? Apparently, no, it's not a derivative. It's not a derivative, Hannah, because electricity is a non-financial instrument. So because it's a non-financial instrument, we call it to be a non-derivative. But if I go further, this contract is in a foreign currency. Foreign currency is a financial instrument. So this is a contract where we are purchasing electricity, which is a non-financial instrument, but in a foreign currency, which is a financial instrument. So it's a contract with both the elements, a non-financial and a financial. So the financial instrument impact of the foreign currency is going to be called a derivative. And any derivative which is along with a non-derivative is called an embedded derivative, an attached derivative, an included derivative. So cases where we have a foreign currency impact, then we say it's it's an embedded derivative. Now, similarly, if I go back to the previous question, in that case also we made a contract of the steel, which is a non-financial instrument, and because it was in the foreign currency, it had a financial instrument impact as well. So in this also we had the embedded derivative, but because we were not expecting it to be settled in cash, and the question did not mention the details about the embedded derivative, that is why we didn't go into that much of detail. But in this one, the question has written that there's an embedded derivative. So this means the accounting for the non-derivative should go to IAS 37, and the treatment of embedded derivative should go to IFRS 9. And when we say IFRS 9, normally the derivatives, if they are used for other than hedging, then their gain or loss should go to the P&L. And if they are used for the hedging, then we need to decide what type of hedge it is. So this question is comparatively a more difficult one than the previous, because it has both the impacts. Getting this, everyone? Hannah saying, I wish I could refund my exam. This is too hard. Hannah, don't worry. Actually, it is too hard. There's no second thought about that. But it is the way people pass SBR. Harun is saying, can you please repeat the last point about hedging? Harun, I was saying that now that it has a derivative, the derivative has two uses. Either it is going to be used for hedging or other than hedging. So if it's other than hedging, we should be treating it to the P&L. And normally the embedded derivatives are what are treated in the P&L. So let's complete the question and then start to write down the answer. It says that and measured it at fair value through OCI. So that's actually what is wrong. It should be measured at the fair value through P&L. Bongani, not exactly. The derivatives other than hedging purpose are treated in the P&L. And that's not because to reduce the accounting mismatch. That is a separate point and this is a separate point. Huawei is saying that I can't see the screen. Huawei, I've updated the question, so you should be able to see now. However, on 31st December 2007, there was a contractual modification. So we have modified the contract later on, such that the contract is now an executory contract denominated in dollars. So we changed the contract back to be in the dollars. This means now after the modification, there is no more embedded derivative into it. After the modification, the embedded derivative has been removed. Harun is saying how to differentiate and identify a hedging purpose. Harun, that will be mentioned in the question that we have purchased it to basically minimize the risk. Now the question says at this date, crypto calculated that the embedded derivative had a negative fair value of 2 million euros. This means we will have to pay 2 million euros as a compensation. The directors of crypto would like advice as to whether they should have separated out foreign currency derivative, the first part of the requirement. Whether they should separate or not, the answer is yes, they should be separating because they are going to be dealt in two different accounting standards. And measured it at fair value through OCI. And is measuring at fair value through OCI correct? No, that's wrong. And how to treat modification in the contract? So modification is a change in an estimate. So we should be treating this prospectively. So there are three questions asked by the examiner in this. So if I go and if I write the answer of crypto, we are going to say that forward contract to buy a financial instrument, forward contract that relates to a financial instrument is treated as a derivative. And if it relates to a non-financial instrument, it is treated as a non-derivative. In case of crypto, it has signed a forward contract of electricity, which is a non-financial instrument. But as it is in a foreign currency, it also has an embedded derivative in it. As the accounting, or we can say which shall be accounted for under IFRS 9. Therefore, it is necessary to separate the embedded derivative as its accounting would be different than the other part of contract. In such case, the derivative is held at fair value through profit and loss. Therefore, the treatment of crypto to measure at fair value through OCI is incorrect. So we have answered two parts of the question. That should it be separated out? Yes, it should be separated out. Should it be measured at OCI? No, it should not be measured at OCI. Now the last part is how to treat the modification. So we are going to say at the time of modification, the contract no longer has the embedded derivative. Therefore, this change should be dealt prospectively, and as the fair value is a negative $2 million, crypto will have to pay this amount as a compensation. For the later years, the later period, the contract shall only be measured under IS 37 to check for any onerous contract. So this is what was supposed to be written in this answer. Cindy is saying, sir, can you put the answer also on the drive for IFRS 15 to do? Cindy, are you talking about the question which I have mentioned to do at home or the one that I have written already? Okay, Cindy, I will try my level best. I cannot exactly promise, but I will try my level best for that. Kashifai is saying, sir, could you please say the most important list of questions from the past papers to be done before the exam? Okay, Kashifai, I will tell you people the important standards and which benchmark questions should be done along with that. I will update it on the WhatsApp group. Cindy is saying 2 million, from where did it come? Cindy, 2 million, is that this amount negative fair value of 2 million? Imran is saying, please, one more question of IFRS 9. Imran, if you want one more question, you can actually solve the question of Margi. This part of the question is also IFRS 9. You can try this as well. So you can take the snapshot. Harun saying, will we discuss the cryptocurrency? Harun, we don't have time now to discuss that area, but the technical article is quite simple. You can actually go through it. And if you have any challenges, you can discuss that with me. Mohammad Lamin is saying your final advice for the exams. Mohammad Lamin, I will update a small video on the final advice for the exam on the WhatsApp group. So stay connected with that. Kashifa is not on the group. Zahira is not on the group. Angela is not on the group. Actually, all of the people who have registered, I will send an email probably tomorrow sometime with the link, the WhatsApp group, and all of the recorded lectures so that you people who are not there can join and access these materials as well. Yes, Angela, I will share. Hannah, same goes to you. Okay. Hina also has AAA paper, so she has comparatively less time to study. Hina, the main area are the knowledge of the standards, which is more important than the past papers, because the past papers would not repeat, but the knowledge would repeat. If we see, we use the same knowledge in two different questions, but the question was actually different. So the past paper will always be a new one, but the concept, the logic behind will always be the same. So I generally prefer more of the revision of the rules rather than the past papers. People can take the snapshot. Thank you, Imran. Okay, I'm going to share the main areas on the group because I need a bit of research on that before just mentioning the areas. I'm doing an analysis of the past papers, after which I will give an important list of standards and the important list of the questions to cover that. Gania is saying investment property is a non-financial asset, then why don't we use highest and the best use of to value it as per IFRS 13? Gania, you are talking about investment property. So basically investment property has a single use, which is the investment purpose. And I saying if you practice last three past papers thoroughly, is it enough to pass SBR? Yes, Hannah, because you have comparatively less time, so I would say the 3 or 5 past papers should be enough to have an idea of what the examiner asks and what are we expected to do. Yes, Huawei, there's only one WhatsApp group. Sam is saying, so you say that the derivative element is gone because the currency element has changed to dollar own. Yes, exactly, Sam. That's the reason why we are saying that it's no more a derivative. Yes, Sri, I will email as well. The lecture will be available tomorrow on the YouTube. Mohammed Ali, I would suggest not to go in that part of the detail. Yes, Hiba, I'm going to share a mock probably tomorrow. And that will be attached in the email as well. Kashif, I will send an email that will allow you to access the WhatsApp group. Hannah is saying how to access last two papers, last two P2 papers. Hannah, the papers of P2, I actually have them. So you can drop me an SMS on the WhatsApp. I will share with you over there. So thank you everyone. Thank you for the revision session, and I hope it was useful. Um Although obviously we cannot complete the entire course in a small revision session, but we try to focus on the important areas, technical areas which the students find challenging to be. So thank you everyone. Best of luck for the exam, and I'm hopeful that a positive feedback will be there after the exams. So till then, you also remember in the prayers, everyone. Thank you and Allah.